Hey everyone, it's Delta Edge here, and today we're diving deep into the world of mutual funds, specifically for those of you who, like me, prioritize safety and steady growth over risky bets. Listen, I get it. You've worked hard for your money, and the last thing you want to do is throw it into something that could potentially lose value. That's why we're focusing on mutual funds with lower risk profiles. Funds that aim for consistent returns while keeping your hard-earned money as safe as possible. But that's not all. Because you're a Delta Edge viewer and I like to reward you for being part of this amazing community, I've got something special lined up. If you stick around until the end of this video, you'll have the chance to get your hands on a reward worth a whopping 21,000 rupees. Plus, I'm giving away 10 of my personal favorite financial calculators, absolutely free. So stay tuned to find out how to claim yours. Alright, let's jump right into it with our first fund, the ICICI Prudential Balanced Advantage Fund. Now, this fund is like that reliable friend who always seems to make smart choices, never taking unnecessary risks. It's all about finding that sweet spot between growth and stability. You see, the ICICI Prudential Balanced Advantage Fund follows a dynamic asset allocation strategy. What does that really mean? It means that the fund managers are constantly adjusting the portfolio, shifting between stocks and bonds based on market conditions. Think of it like this. When the stock market is looking bullish, the fund will increase its exposure to equities to capitalize on the potential for higher returns. But hold on. That doesn't mean they're going all in on risky stocks. Oh no, this fund is all about balance. As the market starts to get a little volatile, the fund automatically starts shifting towards more conservative investments like bonds. It's like having a built-in safety net that helps protect your investment from those market swings. This dynamic approach is designed to give you the best of both worlds. The potential for growth when the market is up and a cushion of stability when things get bumpy. And let me tell you, that kind of peace of mind is priceless, especially in today's unpredictable market. Now you might be wondering, Graham, what kind of returns are we talking about here? Well, while past performance isn't a guarantee of future returns, the ICICI Prudential Balanced Advantage Fund has consistently delivered competitive returns over the long term. Remember, this isn't about getting rich quick. This fund is for those who are in it for the long haul, who understand that slow and steady wins the race. It's about building a solid financial foundation brick by brick, with a fund that's designed to weather any storm. But don't just take my word for it. Before you invest in any fund, it's crucial to do your own research, understand the fee structure, and make sure it aligns with your overall investment goals and risk tolerance. Remember, knowledge is power when it comes to investing. The more you know, the better equipped you are to make informed decisions about where your money goes. Alright, moving on to our next contender, the HDFC Short-Term Debt Fund. Now, this fund is all about stability and consistency. It's like that solid, dependable friend who's always there for you, no matter what life throws your way. So what exactly are short-term debt instruments? Well, in simple terms, these are investments in debt securities with shorter maturities, typically ranging from a few months to a couple of years. Think of it like lending money to a company or the government for a short period, and in return, they pay you interest. The beauty of short-term debt funds is that they tend to be less volatile than funds that invest in longer-term bonds or stocks. Remember, the longer the time horizon, the greater the potential for fluctuations in value. With short-term debt, you're reducing that time horizon, which can lead to a smoother ride for your investment. Now, the HDFC Short-Term Debt Fund, in particular, has a strong track record of generating consistent returns while maintaining a high credit quality portfolio. What does that mean for you? It means your money is being invested in relatively safer debt instruments issued by credible borrowers. This fund is an excellent option for investors who prioritize capital preservation and liquidity. If you're someone who might need access to your funds in the near future, or if you're simply not comfortable with the ups and downs of the stock market, the HDFC Short-Term Debt Fund could be a great fit for your portfolio. Remember, diversification is key to any successful investment strategy. Don't put all your eggs in one basket. By including a short-term debt fund like the HDFC short-term debt fund alongside other investments, you're essentially building a well-rounded portfolio that can potentially weather market volatility more effectively. And just like with any investment, it's crucial to do your due diligence. Understand the fund's expense ratio, look into its historical performance, and make sure it aligns with your overall financial goals and risk appetite. Investing doesn't have to be complicated. With the right knowledge and a little bit of research, you can make smart choices that set you up for financial success. That's it for today's deep dive into the world of conservative mutual funds. Remember that reward I mentioned earlier, the one worth 21,000 rupees? Well, all you have to do to be eligible is hit that subscribe button. Turn on notifications so you never miss an upload, and send a screenshot of this video playing on your device to the number that appears on your screen right now. And don't forget about those 10 free financial calculators I'm giving away. Just send a WhatsApp message with that same screenshot to the number on your screen, and I'll personally make sure you get your copy. Thanks for joining me today. And remember, knowledge is power when it comes to building a secure financial future. Like and share this video with anyone who could benefit from these conservative investing strategies, and I'll see you in the next one.